Good evening, we are Tuesday 18th of December 2018. Here's a quick market update on the Chinese slowdown and its impact on stock markets. The Chinese economy is showing worryingly signs of slowing on the back of tighter credit conditions at home and worries about trade overseas. Retail sales figures on Friday showed the growth at its lowest pace for 15 years in November, while factory output was at its weakest for 3 years. Both numbers suggest that recent efforts by Beijing to revive flagging growth is failing to gain traction. Although China was keen earlier in the year to rein in credit to cap high overall levels of debt in the Chinese economy, it has recently started to worry that it cannot address borrowings at the same time as fighting a trade war with America. Evidence is mounting that Chinese consumers are starting to rein in their appetite for spending, with sales of big-ticket items like cars going into reverse. China has been the world's leading car market for 9 years now, but the latest data tell a different story. China is looking at the first decline in car sales since the 1990s, as car purchase subsidies come to an end and poorly performing stock and property markets undermine confidence. Collateral damage from this slowdown is being felt all over the world. Just this week, Jaguar Land Rover said it might have to lay off 5,000 workers as it attempts to counter a slowdown in sales. It has been hit by a triple whammy of flagging interest in diesel cars, less demand in China, and the cost of retooling its business for a less favorable post-Brexit world. The slowdown in China coincides with the 40th anniversary of the introduction of market reform in 1978, that effectively set the country on its remarkable recent growth path. On this day, 40 years ago, Deng Xiaoping, China's leader, announced a dramatic shift in approach from the politically focused Cultural Revolution of Chairman Mao to a more economically focused approach aimed at lifting China out of its then grinding poverty. The success of the new policies introduced in 1978 is well known. Less clear is what might happen over the next few years as the current leadership under President Xi Jinping takes the country on a more Maoist, inward-looking direction. The poor performance of the Chinese stock market is a combination of many factors, but it reflects in part anxiety about the direction the global economy is taking away from the open globalization that has been so helpful to China's development. It's not just China's stock market which is worrying about China. The S&P 500 ended last week on yet another weak note on the back of the Chinese data, and the US market picked up where it left off yesterday, closing another 2.1% lower to hit a 14-month low. Wall Street has now registered a series of lower highs and lower lows since peaking at more than 2,900 at the end of September. At today's level of just under 2,550, the US market is firmly in correction territory, having lost 13% since its high in September. Smaller US companies have fared even worse, with the Russell 2000 index now more than 20% lower, and therefore in bear market territory. Last night's weakness spilled over into Asian markets, with Japan's Topix down 1.7% to hit a 18-month low. Well, that's all on this short topic. Speak to you soon. Goodbye.